Assalamualaikum warahmatullahi wabarakatuh. Our presentation today is on Sarbanes of the Act 2002. The members of our group is Hanan, Faridin, Shahira, Haja and Hidayu. The outline of our presentation is the first one background, second important section is spec of SO Act, and the last one is criticism.
Sarbanes of the Act. SOX was passed by US Congress in year 2002 in a hope that they can protect investors from possibility of fraudulent accounting activities by corporations. Different from other code of corporate governance, SOX is a legislative or rule-based approach. It was enacted in response to accounting scandals. There are enormous accounting scandals that had occurred before, but there is no specific regulation to overcome these scandals. And Ron Tycho Volkov has shocked the investor about confidence about the financial statement. How is it possible for management to manipulate the financial statement for their own interest and benefits? The Act was the most far-reaching US legislation dealing with securities in many years and has major impact to the public companies. It contained 11 sections ranging from additional corporate board responsibility to criminal penalties. In this video, we will share 5 important sections.
Today I will present on the Sarbanes-Oxley 2002 under section 302 that focus on corporate responsibility for financial report. This section designs internal procedure to ensure accuracy on financial disclosure, which means any material information relating to the company and its subsidiary made known to officers by other within entities during period which periodic reports are being prepared. So they must follow this statutory financial. The first one, CEO and CFO must review all financial report. Second, financial report does not contain any mispresentation. Information in the financial report is fairly presented. CEO and CFO are responsible for the internal accounting control. Next, CEO and CFO must report any deficiency in internal accounting control or any fraud involving the management of the audit committee. The last one, CEO and CFO must indicate any material changes in internal accounting control.
Okay, next I will share about section 401 on disclosure in periodic report. As we know, all public listed companies need to disclose their financial statement. There should be appropriate disclosure of material of balance sheet transaction and all transactions that will affect the financial condition. Although it is not recorded, it should be disclosed in the note of financial statement. The material of balance sheet transaction may also include contingent liability. So, what is the importance of this disclose? The first one is to show the real possibility condition of the company. Second one, it is important for the decision maker whether it is internal or external. The company needs to make its financial statement as true as it can. Probable means that the future event is likely to occur. Firm should describe the liability or asset in the footnote that accompany the financial statement. If the probability is more than 50%, they need to adjust. If it is more than 20%, it needs to be disclosed in the note, and if it is lower than 20%, it is considered as reward. That's all for section 400.
Now, I will explain about Section 404 of Sarbanes-Oxley Act 2002. Section 404 of Sarbanes-Oxley Act 2002 required the Security Commission to develop and publish rules for a management assessment of internal control over financial reporting. Those rules were completed in June 2003, and the Public Company Accounting Oversight Board followed with its Accounting Standard 2, which was approved by Security Commission in June 2004. Together, they required that management perform a formal assessment of its internal control over financial reporting, including testing to confirm both the design and operating effectiveness of the controls. Management need to include in its annual report on Form 10K an assessment of internal control over financial reporting. Then, the content of internal control. A statement of management's responsibility for establishing and maintaining adequate internal control over financial reporting for the company. Second, a statement identifying the framework used by management to conduct the required evaluations, management's assessment of the effectiveness of the company's internal control. A statement that the registered public accounting firm had audited the financial statements.
Lately I got this feeling, I don't know what's the meaning, but I know it's strong and it's over you. All I want is to be home with you. I'm coming right back home. Living without you is a no. I'm coming right back home. I wish you were here. Yeah, I wish you were here. Music is better and lights are brighter when you are near. Am I making it clear? The music is better, and right now I just wish you were here. Right now I just wish you were here. Right now I just wish you were here tonight.
Management need to understand Accounting Standard 2 because it explains how the external auditor will review and assess management's assessment process. It is also important if to contain costs, management is planning to minimize audit fees by maximizing reliance on management testing. However, management needs to ensure its process is faithful to the principles behind Section 404, that is, provide a fair assessment of the organization's internal control as the year-end, reflecting whether the system provide reasonable assurance that material misstatements will be prevented or detected.
Now I would like to share about Section 409, Real-Time Issuer Disclosure, which you can see here. Company or issuer are required to disclose to the public on an almost real-time basis information concerning material changes in the financial condition of or operation. This disclosure needs to be presented in ways that are easy to understand, which supported by trend and graphic presentation. The goal of Section 409 is to protect investors from delay reporting of material events. This is the last section for our group presentation. Section 802 of Sarbanes-Oxley Act 2002 is related to the criminal penalties for altering document. This section describes about penalties of fines up to 20 years imprisonment for altering, destroying, mutilating, concealing, falsifying records, documents or tangible objects. This acts being followed by the intent to obstruct, impede or influence a legal investigation on the documents being investigated. The penalties is 10 years of imprisonment on accountants who knowingly and without coercion violates the requirements of maintenance of all audit or review papers for a period of 5 years.
Hello everyone. Okay, today I will explain on the impact of Sarbanes-Oxley 2002 in America. The first one is to ensure internal control properly document. The second one, better communication control to shareholder. The third one, external auditor report on what have done. So, with all these, become a greater market confidence in America. In addition, the Act also distinguishes between company and external auditor. The function of external auditor is focused on audit committees. That's all. Thank you.
Okay, next we proceed to international impact of Sarbanes-Oxley Act 2002. First, new legislation conflicted with local corporate governance custom, which means Sarbanes-Oxley Act 2002 give impact to the local governance. Second, SOX influence certain jurisdiction to adopt more rule-based approach, which mean need to revise as to make everything legal and appropriate.
But I will elaborate to you about criticism on Sarbanes-Oxley Act 2002. Even though this SOX is created to handle mostly related to scandals, indirectly give benefit to companies. However, some of the experts on corporate governance doubt it. Some of the expertise that critics on SOX are Robert A.G. Monks and Neil Minor. Both Monks and Minor argue on SOX. Either SOX really give benefit to companies or they always feel a room for improvement. The expertise critics SOX on some issue for some reason. One of the reasons are SOX not being strong enough for the companies to implement it. Okay, both Monks and Minor have criticized Sarbanes-Oxley for not being strong enough on some issues. For example, the selection of external auditors by the audit committee and at the same time over rigid on others. Other than that, they believe that legislation could override lawyer-client privilege. Therefore, directors may be less likely to consult lawyers in the first place. Both Monks and Minor believe that SOX is a distraction of improvement of information flows. This has distracted the companies from improving information flows to the market. This is because the company is focusing more on complying with SOX rather than other more important aspects. For other reasons, they believe SOX increase compliance costs. These costs are associated with SOX implementation. This implementation has reduced flexibility and corporate risk-taking indirectly decreased the return for the companies. Other than that, they criticize that SOX is expensive and less important for small companies rather than the large one. Big companies usually are more complex and organized, thus they are more suitable to implement the SOX rather than the small one. For the last reason, the critics that The nature of the SOX itself is the regulatory regime. SOX is a rule-based approach, means that the compliance must be absolute. This choice is not available. Thank you.
As a conclusion, security laws like Sarbanes-Oxley are complicated and confusing, but for US companies, the failure to follow the Act can result in severe penalties. Prior to SO Act, federal and state law didn't establish specific standards for corporations in compiling the information they fed to the public in their financial reports. In the event that investors were damaged or defrauded, the investors themselves were responsible for persuading judges the information they had received was truthful or accurate, without any reference to specific standards. Now, plaintiffs may strengthen their claims and argument by referring to standards set forth in the SO Act.